Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited for you to join me today. Today, we are going to start or actually continue part of our conversation that we actually started in early April on how to prepare for a market downturn as a passive investor. Now, I am going to be doing a series of talks to help people really understand maybe just a little bit of what's going on in the market today, but more importantly, how can you as an investor respond to the volatility that's happening to where you can actually get comfortable with taking advantage of the dips in the volatility and deploying capital into various investments. Okay, so we're going to talk strategy today. We're going to talk some numbers. But I want you to, if you haven't already, go back and watch the video called the Fortress Balance Sheet that I did in early April, because that is really going to help set the base. And then each one of these subsequent videos, we're going to stack on a skill or a concept on top of that Fortress Balance Sheet. Now, the Fortress Balance Sheet video, that is the base video. That's what you should strive to have at any point in the market cycle. But again, today we're going to talk about, okay, the market is turning downwards or we're seeing more volatility. How can you, especially as a passive investor, um, uh, maybe not get 100% comfortable with what's happening, but at least be prepared for your portfolio to kind of ride out these hills and troughs. Now, again, I do this webinar series to help you turn your passive or your active income and savings into passive income and build wealth. And so maybe you've tried to invest in a passive deal before and just couldn't get comfortable with it, or you actually were in a passive deal or in a passive deal and you're like, oops, I made a mistake, or simply you just want to sharpen your skills. If that's you, you're in the right place. Now, a little bit about me, this is the first time we're meeting, is I live what I teach you guys. These are lessons and skills that I've built over my 22 plus years investing in real estate. I'm now a partner in over 800 million in real estate, residential real estate, self-storage, and some cash flowing businesses. I've flipped over 5 million in residential real estate. I have my role here at passiveinvesting.com as the Director of Investor Education. And also, I coach investors like you one-on-one at Ash Wealth. Now, I'm also the author of the book, Money for Tomorrow, How to Build and Protect Generational Wealth. Now, this book right here, I published it with Bigger Pockets, and really it's the base investing plan for, like, if you're a new investor and you're just needing to get your financial house in order, how do you do it? Or if you're a seasoned investor and you're nervous with what's happening in today's market, go back and read this book. This will help you set that financial foundation that actually kind of helps you sleep extremely well at night and be armed with a war chest of funds so you can deploy into a market that is volatile. All right, now the reason why I do all this is so I can have 100% choice and freedom on how I spend my time. And this is what I love doing, is traveling, especially to beautiful places, but especially national parks, both here and abroad with my family. This is one of our adventures back in Montana and Glacier National Park last July last year. I need to insert a picture. We just recently got back from Hawaii. But again, this is what we love doing. We love spending time out in nature, but I had to build a portfolio that would allow me to do that. And I imagine that's why you're here, is to take some of that active income, some of your savings off the board so you can put it into a portfolio that is going to produce income for you so you can have this result, which is 100% choice and control on how you spend your time. And again, I outlined my journey here in the book Money for Tomorrow, and we can help you do that here at passiveinvesting.com. We have a strong portfolio of over 1.5 billion assets under management in multifamily, self-storage, express car washes, hotels. We also have 400 million deployed in our fix and flip real estate fund. And we would love to have a conversation with you if you want to visit passiveinvestingwithwhitney.com. There you can get priority access to our open deals, have a one-on-one call with me on how we can help you meet your investing goals. And then of course you get all of our free education that we do here at passiveinvesting.com. So either join us at passiveinvestingwithwhitney.com or scan the QR code on your screen. Now, we are going to talk about how to get prepared for a downturn. Now, guys, this is not financial advice, legal advice, or tax advice, so make sure to consult with your team before making any investment decisions. Now, what I love teaching here at passiveinvesting.com is not so much going through the glitzy graphs and, showing a bunch of like Fed charts to you and trying to interpret, through a crystal ball what I think is going to happen in the market. What I love teaching is the strategical foundation on like, how do you respond to these different Fed charts? How do you respond to the headlines you see in the market news? Okay, what is the strategy, not the tactic, okay, not the investment, but the strategies that are going to build your wealth? Okay, so when we talk about how do we respond during and prepare for a market downturn, we have to talk strategy. Now, this is probably what you're seeing in the news today. We're recording this at the end of April. And 2025, we thought, I will say personally, I thought we were going to go into a year that was like a little bit more stable. We knew what was coming, but at the end of the day, I feel like even investors today have to be far more strategic than they have been in the past. Why? Because maybe you're new here and you're just like, wow, I would love to take advantage of the cash flow and growth in passive real estate, the tax benefits, but I'm new. I don't understand what's going on. Or maybe you're just seeing all the charts bouncing around, the stock market bouncing around all over the place. One day it's up 10%, the next day it's down 15. What are we going? Where are we going? Where are we heading? Tariffs are on, tariffs are off. Maybe you're just really nervous, or maybe you've actually been in an investment before and you got burned. Okay, that could be maybe a previous passive real estate deal. It could be a previous business fund deal. I know several business funds have been challenged as well. Or maybe you just lost 15% in the market, at the beginning of April. But I will tell you that even sitting on capital can get you burned a little bit here. But I want to talk about why 2025, you have to take a more strategic approach. One, the recession signals are here. Okay. Everybody for the past 3 years has been saying, when are we going to call a recession? I think we were in a recession in multifamily. I think we are in a recession in some areas of the United States when it comes to self-storage and some business ventures. Okay. Now, but when we talk about the national economy, are we in a recession or are we not? Well, no administration wants the big fat R next to their name. And so every administration is going to do what they can to not call a recession. All right. But we've got some clear indicators here. When the consumer confidence index, as of March, had dropped 7.2 points, okay, to its all-time low in over 30 years. Now, here's the thing. I went to look it up right before today's webinar to get the most recent stat. It's dropped further, but they're not saying what the stat is, okay? I don't really like that when we can't find the information we want to. All right. The expectations index has also tumbled, okay? It's in its lowest reading in over 12 years. Private credit defaults are on the rise. Okay, at the end of March, they were at 5.7%, okay, and they're going up. Inflation in March was just held to, I think, 4.1%, but now in April, the Fed's saying it's 2.4%. Now, what I find surprising about that is if inflation has risen, just 2.4%, which is nearing that Fed target at 2%, but the problem is pricing has gone up over 23% on a lot of consumer household goods. All right, unemployment has ticked up just slightly from 4.1 in March to 4.2 in April, and we still have that inverted yield curve. So again, we've got a lot of red lights blinking on the dashboard saying, okay, this is a challenged economy. If we're not in a recession, if nobody's going to call a recession, we need to know what to do because we probably are already in one. But here's the thing. I want you to understand as an investor, okay, downturns like recessions can create opportunity, right? Because a lot of people will pull capital and sit on the sidelines. So there's less competition, which means you could maybe get better pricing for deals. There's more motivated sellers and operators, so maybe you can get stronger returns in terms from various sellers and operators. Conservative underwriting, the risk is actually lower in a downturn because everybody's expectations on the actual return on the asset have been lowered. Okay, we've come back down to kind of normal. So we're not, looking at a deal and seeing 15% year-over-year rent growth. We're looking at a deal and the operator, or even you, if you're your own operator, is probably saying, "Ooh, for the next couple of years, you might see 1 to 2% rent growth." Okay, so we're seeing more conservative underwriting. But the waiting, especially if you're somebody who likes to have their capital on the sideline, it feels safe. Okay, but even waiting, sitting on the sidelines can be risky because your capital is eroding due to inflation, missed opportunities, and just even kind of this lull of false security. Okay, so let's talk about how we can overcome this. Like, what is the playbook that we can put into place? Okay, well, what we're going to cover today is how to get clear on what you can invest and when you should invest. We're going to get really clear on how to structure what I call kind of all-weather portfolio, taking a little tip in our hat to Ray Dalio's all-weather portfolio, and do so from the ground up, very strategically. We're going to talk about how to use debt, notes, and equity in a smart way, a layered way within our portfolio. And just really, like, once we kind of cover, bullets 1, 2, and 3, you can actually feel more confident. Yes, I do have capital that I can deploy and invest. Now, here's the thing. I put the picture of the maze. If you're watching the video, there's a picture of the maze. Now, for me, I've always thought I was weird solving mazes. I always would go to the middle of the maze and then try to figure my way out. I never started at the beginning of the maze and tried to figure out my way in. Turns out that's the most efficient way to solve a maze. Okay, somebody just actually called it out to me one day. Okay, it is no different than how we are going to structure our portfolio. We need to figure out what the center is, what that foundation, where should we be and where should we end up? And then we're going to backtrack to where we are and see what kind of chess moves we need to make. Now, the first step here is to get very clear on your goals and liquid with your capital. Okay, the first 2 sections of my book, Money for Tomorrow, walk you through how to exactly do this, how to get clear, how to get liquid. Now, I'm going to give you just some high-level bullet points here that you can follow and, quite frankly, get a long ways. But one, if you don't know, if you're not 110% sure on your burn rate month to month, meaning how much your current lifestyle costs you, okay, you have to get clear. Now, most of my high-income net worth investors, they have a lot of income coming in, and so they kind of take their foot off their pedal, okay? They take their foot off the accelerator and they're like, yeah, I got a lot of income coming in. It covers my expenses. It's fine. I don't need to track on a monthly basis. And quite frankly, this one step, getting extremely clear on your income and tracking your expenses, will help you understand your burn rate and how you can actually manipulate this lever to free up more capital to invest. Okay, but let's just say we're not going to make any changes to our expenses, and we're not going to make any changes to our income. As long as you know you have enough income coming in covering your expenses and there's a delta there, you have a delta to invest. We're mostly wanting to understand your burn rate. What do your expenses cost on a monthly basis? That way we can multiply it by 12 and come up with a reserve amount. So step 2, make sure that you understand what your reserve amount is going to be. Now, if you say you lost your job in a down market and it would take a really long time for you to find a new job, I would carry closer to 12 months worth of reserves. If your skill is in high demand and you lost your job, maybe you can get away with closer to 6 months of reserve. But the thing is, you have to know your burn rate and then multiply it by 6 or 12 or some number in between. All right. Now, that is the amount of capital that we need to have liquid, not tied up in fancy investments, liquid, meaning we need to have some cash in the bank, maybe in a cash value life insurance policy. Pretty much we can get at pretty quickly. And then anything past that is lazy capital. Now, lazy capital could mean additional cash that you have lying around, additional home equity that maybe you have available to you, maybe additional cash you have in checking and savings, or overfunded brokerage accounts. Okay. Now, this step right here, getting super clear and super liquid with your reserves, it creates confidence, right? If something were to happen today in your life, you know, you could go to the bank and like you could float yourself for like 2 or 3 months in cash. And maybe you've got another 2 or 3 months in a money market somewhere, or another 2 or 3 months layered out into a home equity, a line of credit, or into a cash value life insurance policy. Okay. But when you have your house in order, when you know your foundation, okay, and you're 100% confident of it, everything past that, we can figure out how to start tearing out and investing. All right. So I recently went through this exercise with a client of mine. We're going to call her Wendy. Now, here's the thing. When I was re-walking her, through, like at the beginning of April, she was really nervous about what she was hearing in the news and the tariffs. The stock market part of her portfolio was ping-ponging all over the place. Okay. And she's not that far out from retirement. She was like, I'm nervous. And I was like, all right, let's work the plan. Okay, so how do we get confident? Work the plan. Plan the work, work the plan. So number one, we realized that Wendy's burn rate herself was about $10,000 a month, which meant she needed somewhere between $60,000 to $120,000 a year in reserves. Okay, now for her, even though her skill was pretty easy to go to market and for her to get a new job, she was like, Whitney, I don't want to just take any job. I want to be super picky about what job I take. And I'm like, okay, great. Let's plan for 12 months. So we need to have $120,000 fairly liquid for you, which when we added up all of our other equity and other assets, we were able to free up lazy capital to invest. So her lazy capital that was sitting around, and then again, we're going to give part of this a job, is that she had $45,000 in cash and savings in some precious metals. She had over $80,000 in liquid assets in her Roth and IRA. She had over $300,000 in notes that were kicking off a little bit of income, but not a lot. And then $215,000 in cash value life insurance policy and $165,000 sitting in her HELOC. All right. But that's just number one, understanding our burn rate and getting liquid, and then what kind of capital do we have lying around that's not really performing. Step two is now we got to start putting a plan in place, build that smart investing strategy. Okay, here's one of my favorite quotes by Ray Dalio. Markets go through seasons, and you need a portfolio that performs no matter what season we're in. Meaning your portfolio shouldn't just be for, hedging, recession. It shouldn't be just, it shouldn't only just perform whenever the equities are skyrocketing in the growth part of the cycle. We should need to figure out how to smooth the ride and eventually kind of go up and to the right on the graph. Okay, that's where he created his all-weather portfolio. But I took a little twist on this and I created the all-weather framework for a passive investor. So essentially, for somebody who's very heavy into real estate, when markets are hot, equities are going to shine. You get appreciation upside. When the markets are cool, the debt and notes are going to be help protect your capital and produce steady income. But when things get a little messy, as they are right now, we need to be flexible. Flexibility is going to be your superpower. Okay, so again, rather than try to build a portfolio that's going to time the market, we need to stop doing that and build a portfolio that is going to respond with the seasons. So with this lens, we go back to our friend Wendy here, okay? And it's actually step 2 still. We're not to step 3. So she has her reserve, $120,000, okay, that we need to hit. So we rearranged some of her capital to allocate it to tiers. So the tier 1, this is going to be her $120,000 reserve. We earmarked the $45,000 in cash that she had and leveled it up into money markets and some T-bills that gave her about 4 to 4.75% return. So she's beating inflation. If inflation's truly 2.4%, she's almost doubling, outpacing inflation by 2x. Okay, now Wendy still wanted to grow her portfolio. She was like, even though I'm nearing retirement, I still want to grow my portfolio with a nice debt layer. Okay, so that meant we had to free up some cash for her to continue to grow that. So we decided to earmark 75,000 of her cash flow life insurance policy for reserves. Now her policy, that cash in her life insurance policy, is 5.5% is what she's earning a return on there, and it's compounding year over year. But that's 75K that she's not going to touch, never take out a loan. It's going to sit there in case she needs it. It's like her little bank. And then we layered on a tier 2 for her because, again, Wendy's extremely conservative. And so she didn't want to just have one layer of $120,000. She wanted another layer in there that added a little bit of buffer and cushion. So we earmarked another $80,000 in our Roth and made sure that those were in debt and promissory note positions that kicked off somewhere between 8 to 10, 8 to 12% tax-free. Meaning, if she needed to, if everything hit the fan and she burned through the first tier of $120,000, she could go into a Roth, okay, reduce her basis and pull out another 80K. But that Roth there is kicking off income. And then we earmarked another piece of her cash flow life insurance policy to do what we call an arbitrage strategy. Now, this isn't for every investor, and this is not financial advice, but it made sense for Wendy. So she could take another $140,000 in her cash flow life insurance policy and arbitrage it into very liquid, semi-liquid debt instruments and get an extra bonus of 4 to 5% on that cash. All right. If she needed to, she could liquidate the notes, pay off the cash flow life insurance, loans, and then she could take out that additional $140,000 in cash if she needed to. But that leaves us with, how does she deploy the 300 plus capital that she already has out there working, plus utilize the 165K in the HELOC? Remember, we're preparing Wendy for a market downturn, but we did realize that she has over $460,000 here that she could invest. All right, that's where we get to step 3, deploying capital. Okay, and this is going to be different for everybody. This is where I love investment groups because you can, essentially meet operators. You can learn about other asset classes that people are investing in. But this is also what I don't like about investing groups, is that people borrow each other's investing plans without actually doing the work themselves. So I encourage you to sit with these questions. What is your timeline horizon? Okay, what phase are you in? Are you still in accumulation phase? Are you still 15 plus years from retirement and you have a little bit of time to recover? Are you in that transitionary window, say 5 to 15 years away from retirement, where you need to start kind of taking some equities off the board and making them, building out that cash flow layer? Or are you like in so close to retirement or in retirement that you just need cash flow? Okay, let's preserve what we have and make it work super hard. What do you want your portfolio to do? Okay, do you need it to kick off cash flow? Do you need it to build equity? Do you need it to be diversified? And we're going to talk about diversification here in a second. What's your appetite for risk? All right, not everybody has the same appetite for risk. The question I usually ask all my investors is, what's going to keep you up at night? Don't invest anything or with anyone that's going to keep you up at night. And then number 4, look at what the market is giving you. We're going to deep dive into that here in a second. But again, remember, pro investors never copy another investor's strategy without first understanding their own. Okay, so question number 4, what is the market giving us? We've talked for the several months on where we are in the market cycle. Okay, we moved through hyper supply over the past probably 12, 18 months. We're moving into less, the recessionary part of the environment. Some of the market is coming out. Some areas of the United States are coming into recovery right now. And then, eventually what we're going to start seeing is this expansion phase. Okay, but we need to know where we are. For the most part in the United States, we're still somewhere either coming down into the recessionary part of the environment or somewhere in this trough. Now, we have to layer on the debt cycle as well. When we hit this particular area, this is where credit becomes less available. So when we ask the question, what is the market giving you right now to invest in? That is debt. That is, first position debt, secondary debt, okay, debt-like investments. All right. Now, yes, you can find equity. We're going to talk about that here in a minute. You can invest in a multifamily deal or a self-storage deal. Okay. But we need to make sure that you're not catching a falling knife doing it. So let's look at the tiered approach to investing. Okay. How do we build that all-weather portfolio from the ground up? Okay. Now, I would love to have added a basement floor to our pyramid house over here. And that is having that tier 1 liquid reserve capital in place. Okay, make sure we've got that. Okay, once you have that foundation, the reserves, the liquidity, then we can start building the house. Okay, then the ground floor is going to be our debt, our senior debt layers. Okay, very low risk. We're going to stay in first position liens. We're going to keep stay investments to where we have liquidity. We can get at the cash, say, in 2-3, months. Okay, pretty liquid. And this is going to be majorly an income play. So one investment that we have for our investors is our PIK debt fund. All right, then once you've got this layer stable, we're going to start building the second floor. The second floor is going to be our secured cash position. So we're going to get a little bit more bang for our buck when we invest. It's semi-liquid, meaning we're not tying up capital for 5, 7, 10 years. Okay, we're probably going to be in, say, a 12-month to a 36-month position with very low or minimum volatility. Okay, this would be represented here, would be our PIK yield fund. All right, so our senior debt position probably going to yield 6 to 10% return. And then the mezzanine debt, we probably could target closer to 10 to 14% return. Now, both of these are debt, okay? Right? Lower risk, potentially lower return. Once we've got these layers stable, then we can start building the upper layers of the house. Okay, these are going to build long-term wealth growth, but they're going to be riskier positions or equity positions. This is how you build a house. This is how you build a portfolio that is going to weather volatility in the market, whether the market goes up, down, or sideways. This is true diversification, all right? Because what we saw is a lot of people invested just in the equity layers, but they were in maybe multifamily, self-storage, mobile home parks, residential assisted living. But when you're in the equity layer, those are all exposed to interest rate adjustment, expense increases. We need to make sure that we are in other layers of the capital stack that will take advantage of where we're at in the market cycle. All right, so here's kind of, another way to look at it. If you're just like, Whitney, your house analogy is cool, but give me a graph. This is your graph, all right, of where you could put your capital today if you're building out your different layers, okay? Debt fund, promissory notes, those are going to help preserve capital, okay? Ideally, private equity real estate preserves capital too if you're buying it right, okay? Debt and promissory layers are going to kick off passive income if you're buying it right. So should your private equity real estate. But keep in mind, these are going to be more exposed to interest rate risk and supply chain risk than your promissory note and your debt funds. Volatility. Okay, cash isn't necessarily volatile, but you can actually smooth the ride with debt and promissory notes as well. Tax benefits, okay? Debt fund, it does not take off a tax benefit. This should actually be a big X. Promissory notes, for the most part, should also be no tax benefits, okay? So sitting in cash in your debt fund promissory notes, those generally are not going to kick off tax benefits. But what's recession resilient, okay? Investing in debt funds and promissory notes definitely can be recession resilient if structured right. So can your private equity real estate. All right. Okay, so let's apply this to Wendy's situation, because remember, we've got about $300,000 plus of capital that she could deploy into her tier 3. So therefore, building her house. Okay, so we built the ground floor or the basement, which was the tier 1 120K reserves. We turned around and we took her tier 2 money and we layered out the ground floor investment. We put that mostly into debt and promissory note investments. Okay, really built a solid cash flowing cow for her there. And then that allowed us to free up $300,000 to invest, but she needed it in a semi-liquid arena. She wasn't quite ready in this market to go into equities. So we repositioned that into a note fund backed by hard assets, in this case, promissory notes. Okay. Now that, between that combination of promissory notes and debt, she's going to remain flexible for whenever she does see an equity investment come across her path. She's going to be able to, liquidate some of those positions and transition that into the upper tiers of her house that she's building. Now, what did we do with the 160K in her HELOC money? We chose not to do anything. Why? Because of the interest rate risk. We don't know if that interest rate is going to go up or down here over the next 12 months. So we decided, Wendy's extremely conservative, we decided to leave that 165,000 as a backstop. And it could double as dry powder for her. So the backstop, it was backstopping her tier 2. So essentially, if she needed cash quicker than what she could liquidate her notes for, then she could pull it from her HELOC, allow her notes to liquidate and pay back her line of credit. But also, if she identifies something that she really wants to be in super quick, she could actually deploy that dry powder and then go to her tier 3 investments, liquidate a position, and then pay off her line of credit. So how are you to think about this, guys? Take the next step here. Remember, get clear on what you can invest and when. Okay, structure an all-weather portfolio. Build the basement and then stack your ground floor on top of it. Okay, you have to understand your goals, risk, and timeline, and then stop waiting. Okay, once you do the sit down, do the math, take a couple, maybe an hour or two, sit down, do the math here. You can start investing with clarity and confidence. All right, guys, this is your invitation to join me at passiveinvestingwithwhitney.com. Again, we can jump on a one-on-one call to discuss your investing goals, talk through what you've seen today, and then you could also get access to our priority deals. If you're here live, don't go anywhere. We're about to start the Ask Me Anything part of the show. What questions do you guys have? First of all, was that useful? Thumbs up, thumbs down. Let me know. Was that useful information? And guys, any comment other than just clicking off is helpful for me, because I want to know what you need to learn in this market in order to be a confident investor. Literally. Thank you, Tosi. Thumbs up. I love it. Awesome. All right, I want you to go to the chat box. What is the one takeaway that you have here? What is the next step that you're going to take in order to, again, be a confident investor in the middle of a potential downturn? What do you need to do? Because it's cool if you sit here and you watch a webinar and you go, oh, that was amazing. But we need to actually grab something. What was your aha? Grab something and be like, I'm going to do that. Put it in the chat box. Ooh, it is very helpful to think in layers like that. Yeah. I always try to train people to, think in kind of like buckets, but sometimes when we think in layers on how we've added different analogies, sometimes you just have to hear the same thing a different way. That can be really impactful. So glad you like that. Somebody said, show all the assets in a simple pyramid graphic. Okay, cool, cool. Yeah, I think we did that, but I could add in the actual asset names. Um, and here's the thing. I think I want to give you guys a little clue is when you go through thinking through your tiers, think of your tiers by investment, not what bucket it is in. Okay. And I'll kind of elaborate there. When we went through Wendy's, hypothetical, well, it's not hypothetical, it's a real person, but her name's not Wendy. When we went through her portfolio, she kept thinking, I don't want to touch my retirement. I don't want to touch my retirement. I'm like, but we need to see where all your money is because I need to see the overall balance here. Okay, so I had to change her mindset. Don't think about, is it in a taxable account or a tax advantage account? We need to look at the different exposures here and put those in each of their tiers on what they could do. Now we might need to, tax optimize at some point in time and move some stuff around. Cool. But we needed to understand, don't think whenever you reorganize, think according to investments, put them in their individual layers because you're going to see your concentration. Don't think about the allocation, say within a retirement account, and if it's a taxable bucket or something. Somebody says, I need to put some of my idle cash into something liquid that earns 4 to 5%. Yeah, I mean, probably a money market right now could do that. And again, it depends if the cash is tier 1 or tier 2. If it's tier 1 cash and you need to be able to get at it in a couple days, money market is probably great. Most of us have credit cards that if something really truly happened, we could like float ourselves, for a month on our credit cards. And then that would give us time to pull, capital out of like our money market funds. We park a lot of cash in VMFXX. It's the Vanguard Money Market Fund. That is not a recommendation, just letting you know what we do. And then, we tear up some cash in the PIC debt fund as well. And we have a note ladder there. Let's see. Need to take a fresh look at the all-weather, all-season planning for my portfolio. Yeah. Meaning to be helpful, you speak way too fast. It does not give listeners time to absorb and become confidently willing to act. Thank you so much for your feedback there, Linda. I do speak fast. However, these sessions are recorded, and so you can go back to our youtube.com page, listen to those recordings as well. If inflation manages to stay low, I don't need to keep huge returns to keep ahead. Right. Yeah. The thing is that, and I agree with that, right? There was actually a very interesting article, I'll have to pull it up, that came out on Fortune, and they looked at people that were in a 60-40 portfolio, 60 stocks, 60% stocks, 40% bonds, and they pegged it against people who were just in a 8% dividend producing fund, and then also people that were all in equities. The people in the 60-40 portfolio over the past 10 years actually lost money to the people in the equities, and both groups lost to somebody who was just in a portfolio that just clipped an 8% coupon. It was a very real graph to take a look at. You don't have to swing for the fences. You just have to earn stable returns and cash flow, and you are going to win. Great breakdown for today's session. Thank you. Thank you. Thank you. I started to see senior housing related opportunities. Are they going out of the bottom of the cycle? So senior housing, to me, they didn't actually, so yes, if they're coming out of the recession, but they weren't in a true like exposure to interest rate. A lot of actually, so what happened, this is, my take on senior housing, is a lot of the senior housing was actually being built before COVID. And then COVID paused a lot of that construction as well as a lot of lease up. So then what should have been delivered over like 5 years, all of a sudden got delivered in 2023, 24, and now into 2025. Okay, but no other senior housing was being built because, there was just so much to absorb. So also we've got the silver tsunami coming. So I do like senior housing from a long-term hold perspective, 10, 15, 20-year perspective. But yeah, I think they're coming out, but I think a lot of that is the supply demand balance is righting itself, not so much interest rate exposure. Now, that said, a lot of those, you have to pay attention to the funds. A lot of those funds I'm seeing, their debt is coming due this year. Okay, so they did have a little bit of the interest rate exposure. So what are they going to do? Are they leased up enough in order to refinance? That remains to be seen. So look, if getting into a senior housing deal that you can see the finances here going forward, I think is great. Senior housing deal, mid-cycle, I don't know. You need to underwrite that with the operator for sure. Awesome. What other questions do you guys have? All right. I'll hang out here for another minute. Next week, we're going to continue the conversation, diving deeper into diversification, right? So I gave you guys the capital stack pyramid, but we're going to take a deeper dive into diversification, what that means in a challenged and volatile market, and how can you layer on deeper diversification strategies into your portfolio. All right, guys. As always, you can reach me at whitney@passiveinvesting.com. Otherwise, thank you so much for taking the time, not only to spend here with me, but to invest in yourself. All right, see you guys next week.